Hi, I'm Janie Bishop, a residential real estate broker here in Southern California. And this video is about the housing market statistics for February 2024 activity in Los Angeles and Ventura counties. And for both of these, the primary transactions went under contract during January and then would have closed in February after a 30-day escrow. So here are the numbers. Median price in Los Angeles County for transactions that closed in February went down just about 2%, but year over year we are up over 12%. So that takes into account any seasonal factors. The sales, the volume dollar of sales that closed went up 8% month over month and up 6% year over year. So a little bit of an increase. In Ventura County, the price increased about 2% also month to month, and year over year is up 10%. There, the sales volume increased month over month almost 10%, and year over year was up 14%. So that was good. And during this time, the transactions going under contract in January, closing in February, the interest rates remained about the same in the mid 6%. 6.62% was the average mortgage rate. It was in mid-February when the rates crept up a little bit closer to 7%. The number of mortgage applications ticked up in January, which makes sense because the potential buyers returned from the holidays and rates had ticked down a little bit. Unfortunately, as the rates increased in February, and not that much, but it went from 6.6 to 6.9, both buyers and sellers went, what's going on, and moved to the sidelines again. More local, in the San Fernando Valley in February, the months of inventory crept up to 2.9 months, which is a slight improvement and about where we were before the holidays. And but that is still a seller's market. Traditionally, 6 months of inventory is considered a balance of buyer-seller's market. So it is still a seller's market, although not quite as strong as it was a year ago. This month, I thought I would get a little bit further into a true understanding of mortgage rates, especially as the Fed meeting and are they going to lower the rates or how many times this year? And there's so much speculation. And so I wanted to explain that the mortgage rates are technically tied not to the Fed interest rate, but to the 10-year Treasury note yields. And customarily, there is a gap between that and the mortgage rates that's somewhere in the neighborhood of 1.5% to 2%. But for the last year, 2023, the gap between the bond rate and the mortgage rate was actually closer to 3%, making mortgages a little bit more expensive. So the reason why is the investors in the mortgage loans, number one, are factoring in a little bit of a fear that the borrowers are going to refinance, have a higher rate of refinancing as soon as the rates drop. So they're factoring that in. And then they are also factoring in that there is not quite as much demand for the mortgage loans. So that's why they're a little bit more expensive. If the rates tick down enough that the investors in the secondary market are a little more comfortable that the borrowers aren't going to be refinancing so quickly, we might see that gap drop a little bit, and that would be nice. As usual, a lot of the real estate pundits watch or discuss prices and our supply and demand, which of course is a proper understanding. But I also think we should be keeping an eye on some of the macroeconomic conditions, which I've been following for a few months and mentioning for a few months, which are what's happening in China's economy because they're having trouble with their real estate, and what's happening in the our U.S. commercial real estate market, primarily office buildings, not as much warehouses and that sort of thing. And lastly, some news has come out in the last week or few weeks, about California's economy, which we should keep an eye on, especially that the unemployment rate in California is higher than the nation. We, of course, have a pretty large deficit here. And additionally, the change in the minimum wage in the fast food restaurant business, we haven't seen the outcome of what that's going to do yet. So anyway, it's important to watch not only the real estate industry, the U.S. economy, and the world economy because they could impact it. If you are thinking about buying or selling in the next 6 months and would like to discuss things further, or you just want to discuss the real estate market, I'm happy to do that too.